All right, back at 44 minutes after. CIT may need as much as $6 billion to avoid seeking bankruptcy protection without a government bailout. Sean Egan is president and founder of Egan-Jones Ratings, says it is highly unlikely that CIT will have to file for bankruptcy. He joins us now from Philadelphia with his perspective. So highly unlikely, Sean, how come?
Well, we think it's highly likely that they will have to file because, as is, the company is broken. The company funding cost is a lot higher than what they can realize on their assets. So it begs the question of how they're going to fill the gap. We think that they are going to have to go through either a voluntary, either prepackaged or a regular bankruptcy filing, and it begs the question of how much they're going to pay their lenders, their borrowers. And we think that they are generating, on an adjusted basis, about $2 billion in operating income, which is not enough to support their 58 or $60 billion worth of debt. If you take the, let's say, $2 billion, you divide it by 10%, you're looking at about $20 billion, which translates into a markdown on their debt of about 2/3.
All right. So I guess my question at this point is, do you think the government's doing the right thing and not coming to their aid? I know it's a very political issue, and there's a lot of ways to make the argument on many different sides here. But what do you think? Government got this right?
The government probably got it right, but you could have made the argument 6 months ago that the government should not have been involved in a lot of these other bailouts. The market discipline has to return. It's always difficult to time it, and you can make the argument that CIT's customers are being hurt. But at some point, the government had to step back and say this isn't right, and they chose this point.
It's kind of wild, though. I mean, this is a company that Sean already got $2.33 billion already from the government. I think it's going to be potentially, if it files for bankruptcy, the first company to do so that got TARP money. What does that mean? I mean, does the government have any recourse in terms of getting any money back?
The government will get some money back, but probably not much. Bear in mind that the 2.3 was invested in the form of preferred. The government also has exposure with the deposits that CIT holds. We think that the government will be lucky if they get about 20 to 30 cents on the dollar, along with the other creditors associated with CIT. If you believe the fact that the notion that the operating income on an adjusted basis is about $2 billion per year and 10% is their funding costs, that's how you get about $20 billion in debt that they can support going forward.
Sean, for the first time, or maybe not for the first time, but you've definitely heard it this week with CIT and zombie bank being kind of used in the same sentence. To me, I'm thinking, are there other zombie banks out there akin to CIT?
There certainly are. And by the way, we've been bearish on CIT for quite some time. Investors had a chance probably about 9 months ago to get out. The bonds dipped down, but then they came back again. Now, obviously, they're depressed. There are some others like other finance companies that you have to watch. The ones that come to mind are Advanta, GATX. You might want to keep an eye on. G Capital has the support from the FDIC, so they're less vulnerable.
All right. We just talked with Bloomberg News' Jonathan Wild, too. And, he made the point, Sean, about how CIT, also government regulators, were saying, even through this kind of leading up to this crisis, that CIT was well capitalized. It has to kind of do with how they can kind of account for things in terms of their accounting. Do we need to change the rules so that things are much more transparent?
Well, the government, unfortunately, hasn't exhibited a high level of acumen in assessing credit quality. Bear in mind that about 3 days before the failure of Bear Stearns, Chris Cox stood up on one of the networks and said that we examined all the investment banks and were comfortable with the capital levels. And 3 days later, Bear Stearns is gone. So I think that it's very difficult for government officials, in fairness to them, to speak the truth when, if they sounded the warnings, a lot of capital would disappear from the companies that they're looking at.
All right, just got a few seconds left here, Sean. So the next chapter here for CIT, it's all about raising capital?
Well, they're going to try to raise capital with any unencumbered assets. Maybe they'll get a couple $2 billion, but that's not going to solve the problem. What they really need to focus on is the fact that their operating income is a lot less than their cost of funds, and so there's going to have to be restructuring.
I do have a few seconds left here. You do look at so many different companies. You talked about that you guys were concerned about CIT many, many months ago. Who else are you worried about kind of in this vein?
There's a lot of finance. Basically, anybody that relies on the capital capital markets and doesn't have the government support is somewhat vulnerable. But there are a lot of companies who we're about 3 years into this credit crisis. There's still a lot of companies that are vulnerable and need attention, and you know, we provide that list to people who want it, and to customers especially.
All right, not going to give us any names there?
Next time. How's that?
I'm going to hold you to it.
Okay,
all right,
terrific.
Sean, thank you so much. Sean Egan at Egan-Jones Ratings joining us.